Welcome back. Earlier today, it was reported the GDP gross domestic product was revised down to 4.9%. If you recall, the prior estimate was 5.2. And what it does is it indicates the economy is not as hot as we once thought. This is potentially giving the Federal Reserve more breathing room to reduce rates sooner than expected. We're also going to see in just a moment how the Fed funds futures have reacted as a result of this. 4.9% we can see is the current, and that is the final revision to the GDP for the fourth quarter, following several quarters of 2.1 to 2.7%. Certainly better than we've seen in the past, but not as good as we once thought just a month ago. Now we can see there are different segments within the gross domestic product. We have the 4.9% headline number, and then it's broken down into PCE, personal consumption expenditure. That is the inflationary measure of GDP, business investment at 10%, government expenditures up 27.3%, and net exports down almost 13%. We're going to make a note, by the way, of why, or better yet, what this means that government expenditures are increasing so rapidly. Here's personal consumption expenditure. It's the inflation measure. It's at 5.8%, higher than the prior quarter, certainly to be sure, but also cooling, which is a good thing because we want to see inflation go down within the economy. We see here net exports, that's down 13%. Certainly, we want to see more imports, or I should say more exports than imports. So this is not really a great figure to be certain. Government expenditures, and this is one of the really big takeaways, is up 27%. And usually when we see such a strong expenditure number, that is not a good sign. And business investment, that's 10%. That is good. That is better than we've seen in actually quite a long time, actually going back to October of 21. Now, take a look at the chart. This is 2007 through 2009. In particular, notice white line, by the way, S&P 500. Just as the stock market really started to crumble, take a look to see what was happening. The government expenditures, the yellow bar, was skyrocketing higher. At the same time, the weakest part of the economy, or at least according to the GDP number, was the blue bar, business investment. So government expenditures up, business investment down. Fast forward to present date, where are we now? The green line, government expenditures up, and up more than we've seen going back at least to 2021. What's the weakest port? Net exports. That's certainly to the downside. Business investment better, but not really as great. So when we see government expenditures as the strongest part of the economy, that's not really a good sign. We saw that in the past leading into the recession of '08. Now, what does this mean in terms of the futures market? Well, this is what the futures market looked like on December 13th. Green line represents the probability the Federal Reserve will cut rates. And the dates at the bottom, the x-axis, represent the meetings, the January meeting, March, etc. On December 13th, we had a 73% chance the Federal Reserve would cut rates in the March meeting. 73% chance now stands at 83%, an increased probability the Federal Reserve will cut rates in March. And with that said, the probability they may actually even cut rates in the next meeting in January, that's at 15%. That's probably, according to the futures market, not going to happen, but we are moving more in that direction. And notice, by the way, the yellow bars here represent the probabilities that the Federal Reserve will cut rates going down to the 5 to 5.25 range. We're currently at 5.25, 5.5. White line is the S&P 500. If you've been wondering why the stock market more or less has been quite strong, it's anticipation of lower rates. Notice as the bars start to move higher, we're currently at a 12.4% chance. As the bars start to move higher, that's when the S&P 500 really took off. So the takeaway from this is that any economic number we see that moves the Federal Reserve closer to reducing rates sooner than expected, that historically that looks like it works well for the stock market. Of course, past performance is not indicative of future results, but that is where the trend looks like right now. So we're going to keep a special eye on all future economic numbers under this view, and we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.